What if I told you that being a successful investor isn't really about having some complex strategy or being able to predict the future? Well, according to Vanguard's legendary founder John Bogle, it's really all just about common sense. So let's dive into Bogle's masterclass and see why keeping things simple is almost always the winning move in the long run.
Warren Buffett hit the nail on the head with this one. Investing is simple, but it is not easy. And that's the perfect way to kick things off. See, the biggest challenge you're going to face isn't about being the smartest person in the room. It's about having the discipline to stick with a simple, yet incredibly powerful strategy.
So what is this winning strategy? Well, John Bogle's core idea is kind of mind-blowingly simple. Just own all of the nation's publicly held businesses and do it at the lowest cost possible. That's it. By doing that, you basically guarantee that you'll capture almost the entire return that corporate America generates over time.
To really see why this works so well, let's walk through this great little story that Warren Buffett himself loves to tell. He calls it the parable of the Gotrocks family.
Okay, so imagine this family, the Gotrocks. And they're not just rich, they collectively own 100% of every single stock in the entire country. They own the whole pie. Every year, they get all the rewards, all the dividends, all the growth. Their wealth grows together, everything is perfect. They are playing a winner's game.
And this is what that perfect world looks like. The family owns 100% of the pie, and since there are no fees or commissions, their wealth just grows in perfect lockstep with the businesses they own. Simple. Clean.
But then, some smooth-talking folks show up. Let's call them the helpers. They sidle up to a few of the cousins and whisper, "Hey, we can help you get a bigger slice of the pie than your relatives. Just start trading stocks with them and we'll, handle the details for you."
And boom, right there, that's where the problem starts. The family starts trading stocks back and forth with each other, but now the helpers take a little commission from every single trade. All of a sudden, the family's total wealth, the entire pie, starts to grow just a little bit slower. Why? Because a piece of it is being eaten up by these helpers.
Now, the cousins trading with each other realize it isn't really working, but they come to the absolute wrong conclusion. They think, we just need better help. So they go out and hire more helpers, these expert money managers who promise they can pick the winning stocks. And of course, these experts charge their own hefty fees for their wisdom. And this just makes the problem so much worse. To justify their fees, these new managers start trading like crazy. And this just racks up more broker commissions, more management fees, and even triggers taxes on capital gains. The family's share of their very own pie just keeps getting smaller and smaller as the helpers take bigger and bigger cuts. So here's the crucial takeaway. For the family as a whole, all of this activity, all of this help, is actually making them poorer, not richer. The more they trade, the more motion there is, the more of their wealth just gets siphoned away. Okay, so that's a nice little story, but let's see how this simple parable translates into a really harsh reality for the average investor. The numbers, well, they are absolutely staggering. Now, you might be thinking, come on, a couple of percentage points in fees, how much can that really matter in the long run? Well, let's take a look at the real impact of those seemingly tiny costs over a typical lifetime of investing. All right, get ready for a shocker. If you invested $10,000 and it grew at the market's historical average for 50 years, you'd end up with $469,000. But after you account for the typical costs of an actively managed fund, your final return is just $145,000. That is a shortfall of over $323,000. The math here is just brutal. I mean, think about it. You, the investor, you put up 100% of the capital and you took 100% of the risk, and yet you only got to keep 31% of the return. The financial system, the helpers, who took zero risk, they basically walked away with almost 70% of your money's growth. It's wild.
So if the helpers aren't the answer, then what is? How does our Gotrocks family get back on the right track? Well, luckily the wise old uncle in the family has some advice.
His advice is so simple, it's brilliant. He tells the family to fire all of their helpers, the brokers, the managers, the consultants, all of them. Then he says, go back to the original strategy. Own all the businesses, and just stand pat. Do nothing. And that is exactly what an index fund does. It's a single, super low-cost fund that just holds a basket of all the stocks in a given market, like the S&P 500. It's not designed to beat the market, it's designed to be the market.
It lets absolutely anyone follow the wise uncle's advice. And look, the data is it's overwhelming. Over the last 5 years, the S&P 500 index beat 67% of the so-called professional large-cap fund managers, and it gets even more dramatic in other areas. 84% of mid-cap funds failed to beat their index, and a mind-boggling 88% of emerging market funds underperformed. Simplicity just wins.
Okay, so you've embraced the low-cost index fund strategy. That is fantastic. But there is one final behavioral trap that gets almost everybody, and it is a powerful one.
Studies show that a whopping 95% of all money invested flows into mutual funds that have just recently gotten a top rating of 4 or 5 stars. And you can see why, right? We are instinctively drawn to whatever's been hot. It feels like the smart thing to do.
But is it actually smart? I mean, really, does chasing these recent high flyers actually lead to better results? The evidence might really surprise you here. Well, it turns out the tortoise really does beat the hare. One analyst tracked a portfolio that was constantly being adjusted to only hold the top-rated 5-star funds. Over a decade, that all-star strategy returned just 6.9% per year. Meanwhile, the simple total stock market index, it returned 11.0%. It wasn't even close. The smart strategy dramatically underperformed, and with more risk.
So the message here couldn't be clearer. Chasing past performance is a loser's game. Yesterday's winners have a really nasty habit of becoming tomorrow's losers. The real key to success is to just buy the whole market at a low cost and then have the discipline to stay the course.
And that brings us right to the final question, the one you really have to ask yourself. Based on everything we've just seen, the story of the got rocks, the crushing cost of fees, the failure of chasing performance, are you playing a winner's game or a loser's game with your money?